Alright, let's get into it. First of all, I'd suggest downloading TradingView so you can follow along. It might look a little confusing when you first open it, but you get the hang of it. And make sure to take notes as well. So this is the S&P 500. It's made out of the 500 largest companies in the US. The weight each company holds is determined by market capitalization or market cap. This is calculated by the company's latest closing stock price multiplied by the total number of diluted shares outstanding. The number of shares outstanding can be found on a company's balance sheet. The balance sheet shows the company's assets, liabilities, shareholders' equity, and it's one of 3 financial statements that public companies are required to report to the SEC. The other 2 are the cash flow statement, which shows cash flow movements from operating, investing, and financing activities, and the income statement that shows the profitability of the company. This used to be the main way that investors would value stocks, and that was until the market became more vibes-based. Other popular indexes are the Dow Jones and my personal favorite, the Nasdaq 100. From an investing standpoint, indices are generally better because they have less risk, but that higher risk from an individual stock means that you could potentially have greater upside gains than an index, but that's up to the individual. For prop firm trading, I prefer to trade indexes because of that lack of tail risk specifically. They're just, in a sense, more predictable. Other assets people usually trade are Forex pairs like these, commodities, and crypto, but I'll be sticking to the Nasdaq. Bonds are probably one of the most important assets. They essentially control the entire financial system, so I highly recommend everyone learns about how they operate, and I'll definitely make a video on them in the future, but I wouldn't worry about them for now. Options are also very popular, but super complicated, so I wouldn't worry about them either. All you really need to know about them for the moment is that most hedge funds use them as a way to mitigate tail risk because they can have very large returns while only paying a small premium. And premium is just the price you pay for the contract. A bull market is where prices are rising, for example, April to October. And a bear market is just the exact opposite, for example, the whole of 2022. Bear markets are actually pretty rare, but long ones like these are easy to predict if you know what you're looking for. Now, you probably know that if you buy an asset and the price goes up, you'll make money. There's also this thing called short selling or shorting. This is when you borrow a stock from a broker and sell it to then buy it back at a later date, hopefully for a lower price so you can profit the difference. When people talk about trading, they're normally referring to trading futures or CFDs. They're basically contractual bets that the price of an asset will go up or down. If you buy or long an Apple future contract and the stock is trading at $100 at the time, if the stock rises to $110, you'll make a $10 profit. Same if the stock goes down to $90, then you'll have to pay $10. You make or pay the difference. The same can be done with most stocks and indexes. Now, while we're on the topic, I think shorting is stupid unless you have some sort of insider info because you're simply taking on more risk than you need to. For example, if I short here, there's only so much the stock can fall, but the stock could go up infinitely, technically. Now, if you don't know what you're looking at, these are candlesticks. They display the historical price movements of the asset for a selected time period. Let's use this green candle as an example. Since this is a bullish candle, this is the open of the candle and shows the first price for that time frame. Now, these thin lines at the top and bottom of a candle are called the wicks, and they represent the highest and lowest price of the asset during that time. And the closing price of the asset is displayed at the top of the candle where the body ends. Now, this is completely inverted for a down candle. It still shows those highs and lows, but the opening of the candle will be at the top and the closing will be at the bottom. So for these examples, I'm on the 1 minute chart. We won't be spending a lot of time down here though. I don't trade this low of a time frame because most of what you're seeing here is just volatility noise and it can't be predicted accurately. This yellow line here shows the last price that the asset was sold at. The line above is what sellers are asking for it, and the line below is what buyers are bidding for it. And this distance is called the bid-ask spread, and the value is also shown up the top here. You'll see these lines down the bottom. This is an example of an indicator. This displays the total volume of the asset being traded during each selected time period. So during this 1 minute, it says 1.21K up the top left. That means 1,210 contracts or shares were traded during this time period. Some other charts you should get familiar with are the DXY. This is the US dollar index and shows how strong or weak the dollar is compared to a basket of other currencies. And this is the VIX or the VIX. It measures the stock market's expected volatility based on S&P 500 index options contracts. So a higher VIX price generally means expected moves in the stock market will be more aggressive than usual. This is mostly used to manage risk, but I'll discuss that in a separate video. Now, trading hours are also super important. Market 24-hour clock is a website that shows you which markets are open around the world. The 3 main times are Asia session, London session, and New York session. Some markets can be traded before and after hours, but trading volatility is greatly decreased. Now, deciding what market you should trade is the first step to creating a strategy. Every market differs, so when you pick one, you generally tend to stick with it. Leverage also plays a big part in the asset you trade as well. This is essentially borrowing money to trade with from a broker in exchange for a small fee. With that additional capital, you can make a lot more money, but you also take on a lot more risk. If you lose more money than what's required to maintain your margin account, the broker will issue you with a margin call where they'll demand you to deposit additional funds or securities into the account. Usually, they'll let you borrow up to the amount of current equity value in your account. So if you aren't able to deposit more funds or just refuse to meet the margin requirements, the broker will sell some of your positions or liquidate your account to settle the debt. So that's it. I think I've covered most of the important stuff. Leave a comment if you have any questions or think I've forgotten anything. In the next video, I'll be covering some uncomfortable truths about retail traders, so subscribe to keep up with that. Bye.